Hi everybody, welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode 136, we're going to kind of dive into some numerical examples that relate to what's been the hot topic in the tax world, especially as relates to estate planning, and that's whether Congress could enact a retroactive change to the estate or gift tax laws. Now, we're not going to get into the question of whether they can or if that's effective, but what I intend to do is just show you more of the general numbers behind what that change might entail, especially because those numbers require an easy conclusion, but a little bit more digging than you might otherwise see. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, some disclaimers are: one, that as of the date of this video, I have no idea what will happen to the gift and estate tax laws, including the applicable exclusions. So, nothing in this video is designed to represent reality or projection, and any accuracy that we might see if these predictions prove right is really just going to be merely coincidence. Now, I put in quotes an easy client example just because it's easy in execution and kind of represents what a client who wants to bet the Vegas odds might do. So let's assume we have a client who's unmarried and just happens to have $15.7 million in assets, and they're worried about a reduction of the gift tax exclusion, so they decide to give away $11.7 million in a lifetime irrevocable trust for their children on February 1 of 2021. So what happens? Well, first, we're going to ignore the effects of GST tax and depletion and appreciation in the value of the gross estate and really just kind of use static numbers, which you wouldn't see in real life, but they make the examples easier because they could get way more complicated if we make those assumptions. So in order to really understand this, you have to understand a key point here, and that's that at death, for estate tax, our client here is taxed on two buckets. One is their taxable estate, which is valued at its date of death fair market value. So in our example, the taxable estate would be $4 million. That's 15.7 minus the gift of 11.7, leaving $4 million left over. Now, on your estate tax return, you also have adjusted taxable gifts, which are valued as reported on previous gift tax returns, in other words, at the date of gift fair market values. So in this case, the adjusted taxable gifts would be 11.7. So that's a roundabout way of saying that on the client's estate tax return, you're still going to be reporting $15.7 million in wealth transfers, minus the applicable credit, which ultimately ends up being the tax that would be paid on the exclusion of 11.7. Now, for all intents and purposes, what we're going to see is that the math works out where this exempts the inclusion or the exclusion equivalent of 11.7 million from the estate tax calculation. But because we have a variable estate tax rate, it's not a flat 40%, we can't necessarily do the math that way. So because of this, I have some examples here, and really the examples are designed to kind of note the results based on the way the tax code says you need to calculate the client's estate tax. We start off with a tax base of $15.7 million, which is simply the $4 million left plus the $11.7 million gifted away, like I noted. Now they'll have an estate tax tentatively of $6.2 million and change minus an applicable credit, which is the tax on 11.7. of $4,625,800. Now, if you're just simply interested in the calculation, I note that it's not a flat 40%. It's $345,800 on the first million, plus 40% of the amount in excess of the first million, which is why I have laid out these calculations in this fashion. As you see, 14.7 is really just the total 15.7 tax base minus a million, which is represented by this 345,800 tax on the first million. Same thing in the case of the applicable credit. So ultimately, the client's total estate tax ends up being 1.6 million here, which is easy. It's 40% of what they have left, 40% of 4 million. Now, what happens if the client dies after the gift and the exclusion ends up being reduced to $3.5 million? Well, before retroactivity was raised as a consideration, What the Code Section 2001 and associated regulations allowed you to do is use the greater of your applicable exclusion at the time of death, or the applicable exclusion used as an applicable credit against gift tax for lifetime gifts. So, in other words, this doesn't take into account any gift tax you pay out of pocket, but it does take into account any portion of the exclusion that you apply to a gift tax applicable credit. So what this means in this case is that for client, even if the exclusion is reduced maybe to $3.5 million, their exclusion will be the greater of whatever they use during life, which in this case is 11.7, or whatever is available at death, which would be $3.5 million. Now, it's important not to confuse the two. The $3.5 million still applies to the total of your taxable estate plus adjusted taxable gifts, but you get to increase it by the amount that you use during your life. But it's not necessarily a straight line increase. It's really just a greater of whichever is used. So if you only used $6 million during life, you wouldn't get to add that to $3.5. You'd really just use the greater of the two amounts, which would be $6 million, and so on and so forth. But long story short, the client really has no change from previous if there's no retroactive law change. They still end up with an applicable credit that's based on the greater of $3.5 million, or whatever they use during life, which would be $11.7 million. So in this case, they still get the full credit for that and end up with the same ultimate estate tax liability. Now, what happens if we have retroactivity? Well, we lose that benefit of getting to use the greater of exclusion available at death or exclusion used during life. Instead, the IRS assumes there's no exclusion used during life if any gifts are made after the effective retroactive date. Instead, we now have a gift tax on that. So what we're going to see is that the numbers ultimately make sense at the end, but we have to walk through two calculations here. If we assume our client dies in 2021, we're going to have to look at the gift tax numbers and the estate tax numbers, noting that the gift tax return is due April 15th, or if earlier, at the due date of the estate tax return, for the reasons that we're looking at here. Now, gift tax has to be paid if there's a retroactive change here. So if we assume no crummy powers, no gift tax deductions, no prior year's taxable gifts, we have a taxable gift here of $11.7 million. So the tentative gift tax on that amount would be $4,625,800. But since our exclusion has been reduced to $3.5 million, we now only have an applicable credit of $1,345,800. So what that means is we end up paying gift tax of $3,280,000 in 2021. And it's paid out of pocket. But there's another catch here. Any gift tax paid out of pocket within 3 years of death gets included in the gross estate. It would seem intuitive to think, oh great, the client reduces their gross estate now to just $720,000 and we have to pay less estate tax. But it doesn't quite work out that way. We still get the benefit of that at the end of the day, but the IRS still makes you reconcile all these numbers, because the taxable estate and gross estate is going to include the $720,000 remaining plus the gift tax that was paid out of pocket within 3 years of death. So we now have the loss of a higher exemption, so we end up with only an applicable credit of $1,345,800. And even though we used up part of that on gift tax, it's restored here because we're calculating the estate tax based on the taxable estate plus adjusted taxable gifts. So our tentative estate tax ends up being $4,880,000, and compare that to $3,280,000 in gift tax over here. But we don't get double taxed here. We don't have $8 million of gift tax and estate tax combined that we have to pay. Because we pulled that gift tax back into the gross estate, we have to reconcile it somehow, and you get a credit for gift tax paid out of pocket. Now it's recalculated as of the year of death to determine what the amount would have been if it had been paid out of pocket in the year of death. But in this case, there's really no change to rates or anything. So we still get a credit of $3,280,000 against our estate tax, meaning that we end up with an estate tax of $1.6 million here, ultimately. And ironically, that ends up being the same amount we would have paid estate tax on before. So before the change, we had a $1.6 million estate tax. After the change, we had a total of $4,880,000 that was taxed, which was the previous estate tax plus a gift tax of $3,280,000. And ironically, $3,280,000 ends up being 40% of the amount by which the exclusion was reduced, $8.2 million here. Now, the numbers don't always work out perfectly in that way at the end of the day, but the significance of this exercise is that we're showing the true cost of a retroactive change to the exclusion. We're going to see that it results in a gift tax possibly paid out of pocket, plus an increased estate tax. Also being cognizant of the fact that there's a gross-up rule that increases your estate by gift tax paid out of pocket within 3 years of death, but then also gives you a back-end credit for gift tax paid out of pocket. Now, if the client had lived 3 more years, we would have had a much lower result, as we're going to see, but the big issue here is that if the change is not retroactive, it only generates additional estate tax if you don't use the exclusion prior to change. So right now we're being whipsawed. We're in a situation where clients are reluctant to use their exclusion if in case things are retroactive, but they want to use it in case it goes away and it's not retroactive. So how do we reconcile these two outcomes, and could the client have been better off in the third example? Well, that's a question for another time, including the effects of living for 3 years after the date of the gift and looking at the GST tax considerations. But as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.